In the realm of banking, the concepts of credit and debit are foundational to understanding how financial transactions are conducted, recorded, and managed. These terms appear frequently on bank statements, accounting records, and personal finance reports, but their implications extend far beyond simple entries in a ledger. To truly grasp the dynamics of credit and debit, it is essential to explore their definitions, how they function within the banking system, their role in personal finance, and the broader implications they have in the economy. Before starting, don't forget to like and subscribe to our channel for more future updates. The definition of debit in banking. A debit represents the money that leaves an account. When a person or a business debits their account, they are either withdrawing funds or making a payment. In simple terms, a debit reduces the balance of a deposit account, such as a checking or savings account. For instance, when you make a purchase using a debit card, you authorize the bank to withdraw money from your account to pay the seller. Similarly, if you write a check, the amount written on the check is debited from your account when the check is cashed. In accounting, debits are entries recorded on the left side of a ledger, and they indicate increases in assets or expenses, and decreases in liabilities, revenue, or equity. For example, when a company buys equipment, the cost of the equipment is recorded as a debit to an asset account because the company has increased its assets. The definition of credit conversely, a credit in banking refers to money that is added to an account. When an account is credited, it means that funds are being deposited, whether through a direct deposit, a transfer, or a payment received. For an individual, this might happen when they receive their salary, a tax refund, or a gift of money. For businesses, credits come in the form of payments from customers, loans, or investments. In accounting, credits are recorded on the right side of a ledger, signifying decreases in assets or expenses and increases in liabilities, revenue, or equity. For instance, when a business takes out a loan, the loan amount is recorded as a credit to a liability account because the business has increased its liabilities. Credit and debit in personal finance. In the context of personal finance, credit and debit play a vital role in everyday financial management. Whether it's tracking your spending, balancing your checkbook, or reviewing your bank statements, understanding how credit and debit work is essential for maintaining financial health. When you use a debit card, you are accessing money that you already have in your account. The transaction results in an immediate debit to your account, reducing your balance. On the other hand, using a credit card means borrowing money from the card issuer with the promise to repay it later. A credit card transaction is not an immediate debit to your account but rather a promise to pay the amount in the future, usually with added interest if the balance is not repaid within a certain period. For individuals who use both debit and credit cards, managing the balance between the two can be crucial for avoiding debt while maintaining liquidity. Debit cards are often preferred by those who want to avoid borrowing money, as they prevent overspending by only allowing purchases within the limits of available funds. Credit cards, however, offer more flexibility, allowing individuals to make larger purchases and repay them over time, but they also carry the risk of accruing debt and interest if not managed properly. Debit accounts in banking. In banking, a debit account is any type of account where debits can occur, typically reducing the balance. The most common types of debit accounts are checking and savings accounts, which allow individuals to deposit, withdraw, and transfer money as needed. Checking accounts are the most frequently used debit accounts because they are designed for daily transactions. People use their checking accounts to pay bills, make purchases, and withdraw cash. These accounts usually come with debit cards and check writing privileges, providing easy access to funds. Every time a payment is made, whether by check, debit card, or electronic transfer, the amount is debited from the account. Savings accounts, while also debit accounts, operate differently in that they are designed for saving money rather than frequent transactions. They typically offer interest on the balance but may have limitations on the number of withdrawals or debits that can be made within a month. In both cases, the concept of debits is straightforward. Money is taken out of the account, reducing the available balance. Credit accounts in banking. A credit account in banking is any account where credits occur, typically increasing the balance. For individuals, common credit accounts include credit cards, personal loans, and lines of credit. These accounts allow individuals to borrow money from the bank or another financial institution, with the promise of repayment under agreed-upon terms. Credit cards are one of the most widely used forms of credit accounts. When you make a purchase using a credit card, you are essentially borrowing money from the card issuer. The amount spent is credited to your card's balance, and you are required to repay that balance either in full or in installments. Credit cards often come with interest rates, and if the balance is not repaid by the due date, interest charges accrue, increasing the overall cost of the borrowed funds. Loans, such as personal loans, auto loans, and mortgages, are another type of credit account. When a loan is issued, the borrower receives a lump sum of money, which is credited to their account. The borrower then repays the loan over time, typically in monthly installments, with interest. Loans offer individuals and businesses the opportunity to finance large purchases or investments that they might not otherwise be able to afford with their current funds. The relationship between credit and debit in banking. The relationship between credit and debit is central to banking operations, as every transaction involves both a debit and a credit. This relationship ensures that every financial action is balanced and accounted for, reflecting the transfer of value between accounts. In a simple transaction, such as purchasing groceries with a debit card, the shopper's account is debited, reducing their available balance. Simultaneously, the grocery store's account is credited with the same amount, increasing their balance. This dual-entry system ensures that both sides of the transaction are recorded, maintaining the integrity of the financial system. Credit and debit in the economy. On a larger scale, the concepts of credit and debit extend to the broader economy, influencing everything from consumer spending to economic growth. Credit allows individuals and businesses to borrow money for significant purchases or investments, driving consumption and production. When people take out mortgages, buy cars, or finance education through loans, they are using credit to access goods and services that they might not be able to afford immediately. This borrowing, in turn, stimulates economic activity by increasing demand for products and services. Similarly, businesses use credit to finance expansion, purchase equipment, and invest in new projects. Without access to credit, many companies would be limited in their ability to grow and innovate. As businesses borrow money to fund operations and expansion, they contribute to overall economic growth by creating jobs, increasing production, and generating revenue. On the flip side, debits in the economy often represent the repayment of credit. As individuals and businesses repay loans, credit balances decrease, reducing the amount of money circulating in the economy. This repayment process can slow down economic growth if it leads to reduced spending or investment. However, it is also a necessary part of maintaining financial stability, as unchecked borrowing can lead to unsustainable debt levels and economic crises. This is it for today's video. What do you think of our video? Feel free to share your thoughts in the comments section below. Don't forget to like and subscribe to our channel for more future updates. Thanks for watching.